Picture this: the world's two economic giants turning the vast oceans into a battlefield of tariffs and fees, potentially jacking up costs for everything from your favorite holiday gadgets to the fuel in your car. Welcome to the escalating trade showdown between the US and China. But here's where it gets controversial. As tensions simmer, these new port charges could reshape global shipping in ways that favor one side over the other. Sparking debates about fairness and protectionism, stick around to uncover the details that might just change how you view international trade. In a move that's making waves across the maritime world, the United States and China are set to implement reciprocal port fees on each other's shipping vessels starting this Tuesday. This escalation affects a wide array of goods transported by sea, including festive toys for the holidays and essential crude oil that powers industries worldwide. It's turning the high seas into a pivotal arena in the ongoing trade conflict between these powerhouse economies. China has already kicked things off by imposing these additional charges on U.S.-flagged, owned, operated, or built ships. However, they've introduced an exemption for vessels constructed in China, which could be seen as a strategic carve-out to protect their own industry. To put this into perspective for beginners, port fees are like extra tolls that shipping companies pay to dock at harbors. And these new ones are specifically designed to target foreign competitors, potentially raising operational costs and influencing which routes ships take. For clarity, China's state broadcaster CCTV outlined the specifics on Tuesday, noting exemptions also apply to empty vessels heading into Chinese ports for repairs. The fees are applied at the first port of call, during a single voyage, or across the initial 5 voyages within a year, with billing cycles starting annually from April 17. This structure aims to create a predictable yet punitive system, but it might complicate logistics for international traders. On the U.S. side, President Donald Trump's administration unveiled plans earlier this year to impose similar fees on vessels linked to China. The goal? To challenge China's stronghold in global maritime affairs and give a boost to American shipbuilding. This stems from an investigation during the previous Biden administration, which determined that China employs unfair tactics, think subsidies or restrictive practices, to dominate sectors like shipping, logistics, and shipbuilding. By clearing the path for these penalties, the U.S. is essentially trying to level the playing field, much like how a referee steps in during a sports game to ensure fair competition. And this is the part most people miss. These reciprocal actions could lead to a cycle of retaliation that distorts global freight movements. The U.S. is slated to start collecting its fees on October 14th, with analysts predicting that China's major container carrier COSCO, listed on the Shanghai Stock Exchange, could bear nearly half of the projected $3.2 billion hit for the container shipping segment in 2026. To illustrate, if you're shipping a container full of electronics from Asia to the U.S., these fees might add up, increasing the final price for consumers. In response, China retaliated last week by announcing its own fees on U.S.-linked ships effective the same date. As Jefferies analyst Omar Nokta pointed out, this could impact about 13% of the world's crude tankers and 11% of container ships. It's a tit-for-tat dynamic that, according to Athens-based Exclusive Shipbrokers Inc., risks creating a spiral of maritime taxation that alters international trade flows in unpredictable ways. Imagine trying to navigate a maze where every turn adds a new cost. That's the potential reality for shipping firms. The stakes are even higher when you consider the broader context. As a countermeasure to China's restrictions on critical minerals, Trump recently proposed an additional 100% tariff on Chinese imports and new export controls on key software by November 1st. U.S. officials also warned that nations supporting a United Nations International Maritime Organization, IMO, plan to cut greenhouse gas emissions from ocean shipping could face sanctions, port bans, or extra vessel charges. China, for its part, has backed the IMO initiative, which aims to make shipping more environmentally friendly by reducing its carbon footprint, a move that's increasingly important as climate change becomes a global priority. Here's where it gets really divisive. Is this weaponization of trade and environmental policies a smart strategy for national security, or is it recklessly undermining global cooperation? Some might argue it's a necessary step to protect domestic industries, but others could see it as a short-sighted approach that harms everyone by increasing costs and slowing down international trade. As exclusive shipbrokers noted, shipping has evolved from a neutral facilitator of world commerce to a tool of geopolitical maneuvering. Despite the challenges, shares in COSCO climbed over 2% in early Tuesday trading. The company has approved a share buyback plan worth up to 1.5 billion yuan, about $210.3 million, over the next 3 months to stabilize its value and protect shareholders. When contacted by Reuters, COSCO didn't immediately comment on the fee's potential effects. Exchange rate: $1 equals 7.1337 Chinese yuan. Reporting by Lisa Bearline in Los Angeles and Liz Lee in Beijing. Additional reporting by Samuel Shen, Brenda Go in Shanghai, and James Pomfret in Hong Kong. Editing by Stephen Coates. Our Standards, the Thomson Reuters Trust Principles. What do you think? Do these port fees represent a bold stand against unfair trade practices? Or are they just escalating a pointless conflict that could raise prices for everyday consumers? Do you believe prioritizing environmental regulations over trade sanctions is the way forward? Or should economic interests take precedence? Share your thoughts in the comments below. We'd love to hear differing perspectives on this unfolding drama.